Breakeven. For more videos like this one, please visit www.sensebusiness.co.uk. Businesses use a break-even chart to illustrate how to track and predict their cash flows. A business needs to be able to calculate how many products they need to sell to make a profit. If the business is not selling enough products to make a profit, they would have to consider the purpose of continuing to trade. The point at which a company has sold enough products or services to have covered all their costs is known as the break-even point. Break-even is when a business is making neither a profit nor a loss. To be able to accurately calculate the point at which a company breaks even, you need to be able to identify all the business costs, such as the cost of raw materials, the cost of salaries, cost of energy, and cost of advertising. These and many other costs all go towards the output of a business. Cost. Cost can be split into two types: fixed costs and variable costs. Fixed costs are costs that do not vary with the amount produced. Items such as rent, advertising, rates, and salaries are fixed costs. An example is that the rent will be €1,000 if one item is produced, and it will be €1,000 even if 500 items are produced. Fixed costs need to be paid even if there is no output. Variable costs. Variable costs are costs that vary with output. Items such as raw materials or electricity are variable costs. Example, if the ingredients to make one cake cost €5, the variable cost for one cake would be €5, but the variable cost for 10 cakes would be €50. The more products a business manufactures, the higher the variable costs will be. This picture shows the fixed costs and variable costs for a local bakery. The items in the green are the fixed costs for equipment, advertising, rent, and salary. The variable costs are gas and electricity, ingredients, and packaging. Total costs of a business are the fixed costs added to the variable costs. A business needs to be able to pay the total costs of a business before it starts to make a profit. A company will break even when total costs equal the total sales. When calculating break-even, it is important to understand how much of the selling price goes towards covering the company's fixed costs. This is known as a contribution. Contribution is equal to the selling price minus the variable costs. Working out profit and loss. The table below gives an example of a business's costs and sales. It shows output, fixed costs, variable costs, the total costs, sales revenue, profit, and loss. From this table you can see that the fixed costs are €800 regardless of the output, and the variable costs increase as the output increases. Calculating total profit. To calculate the company's total profit or loss, you subtract the total cost from the sales revenue. When neither a profit nor loss is made, the company breaks even. This company would have to sell 200 units to break even. Calculating selling price. Selling price can be calculated by dividing the sales revenue by the output. In the example, the sales revenue at break-even is €1,200 and 200 units are sold. This would mean that the selling price per unit would be €6. Break-even chart. Break-even charts can be produced to make the information easier to understand and analyze. The break-even chart shows the sales revenue, the total costs and fixed cost lines. The point at which the sales revenue line crosses the total cost line represents the break-even point. Formulas can also be used to interpret break-even information. These formulas for break-even point, sales price, and variable cost per unit are shown. We have prepared 10 questions for you to practice. Please visit the link below to test yourself. Thank you for watching. For more videos like this one, please visit www.sensebusiness.co.uk.